I am going to, I guess, seamlessly transition into our first panel discussion. And one of the things that we want to examine is that when we look at the new normal, what does it mean in terms of alternate investments? So when limited partners are looking at India today, what is different and what has changed in the real world out there? And I'm joined by three very, very senior industry leaders who I'm delighted to welcome to join me on stage here. Mr. Jacob Chiu from, he's Managing Director of HQ Capital Asia, and he's joining us from Hong Kong. Chris Lowe, also Managing Partner of Axiom Asia Private Capital. Welcome, welcome, Chris. And to our friend Puneet Nanda, Managing Director and CEO, ICICI Venture, joining us from Mumbai. Welcome, Puneet, and a special thank you. ICICI Venture has been a long-term partner to the Limited Partners Summit, and we are delighted and grateful for the support that you and your team have given us this year as well. Gentlemen, welcome. It's a pleasure to have you all on the panel. And I want to quickly get the ball rolling. I know our delegates are anxious to hear your thoughts rather than mine. So let me get going straight away. And Jacob, if I may start with you with some opening thoughts on, what the past 12 months have taught us. And specifically, do share with us, when you think about how you're investing today or the strategies that you're deploying today, what's changed relative to 12 months or 24 months ago? Over to you, sir.
Thank you. Good morning, everyone. So let me share with you, why we kind of invest in India. The reason is more on growth and anything associated with it. So it's demographic, it's a young population, it's a rising of middle class, fast-growing consumption, and also consumption upgrade. So despite of the pandemic, I do not see anything change in 2020, 2021, and also, in the next couple of years. So in addition, I see India, to a certain extent, has benefited or will be benefited by the US-China tension with a lot of multinational corporations. So they're now adopting the China plus one policy. And they are kind of selecting, the one from either Southeast Asia countries or India. I mean, in particular in India, there's a special economic zone that could benefit for that. But having said that, our experience investing in India has been difficult. Mainly because of the slow exit. So a lot of LPs adopt a more capital recycle concept. So what does it mean? It means that they would use the distributed capital to fund capital call. So which means that if a slow exit and slow distribution will affect and slow LPs' appetite to commit capital to new investments. So with the robust public market, which you mentioned earlier, that we have some statistics that in the past 12 months, the current index is kind of double the bottom in March last year, and also 25% higher than 12 months ago. So I see it's the best time for private equity to exit its portfolio company in a very good valuation and return capital to LP so as to allow LPs to reinvest into India. So we committed to quite a number of Indian funds and seeing this phenomenon recently. So we will look at it very seriously.
Okay, thank you, Jacob. Chris, India is attractive but a challenging ecosystem for an LP. Slow exits, that's the view from Jacob. What's your view at Axiom?
Yeah, my view is very similar to what Jacob has mentioned. the COVID situation has kind of hit India harder because the country doesn't have as much resources as some of the more developed countries to control the diseases, do tests, and going forward in the next few quarters to roll out vaccines. So yeah, unfortunately, the country is having a big problem to deal with this pandemic. So that will continue to depress investor sentiment. We know that growing will not be easy, and it will be doubly hard for India to recover from the pandemic. That's one point. But the silver lining is this euphoric public market, like globally. There's been a strong rebound in the public market. In fact, you can call it euphoria in the public market in the US. Everything is going up, and specs are looking for companies to buy so that they can go public quickly. So that could be a silver lining when it comes to some of these Indian companies looking to give their investors an exit opportunity. So maybe something to look forward to.
Sure. Yeah, absolutely. And today some of the quality newspapers from the media stable have reported some leading Indian companies actually actively looking at SPAC-based exits. So it may well become an interesting model of creating liquidity for existing shareholders in some of the larger sort of startups, even some of the more so-called traditional companies. And with that, I'll turn to you, Puneet. I think you international LP guests. Attractive ecosystem, but a challenging one. Exits have been challenged in the past. The notion of SPACs, and also I guess I'll add to that myself, the push made by the Indian stock exchange to some of the more promising startups to live in India with the easing of norms and so on is also opening up new possibilities. But I'd love to get your thoughts in two fronts in terms of lessons from 2020 perhaps, but also this whole question of liquidity and exit, which LPs and of course GPs like yourself also play. What's it looking like these days?
So thanks, Jaideep, and good morning, Jacob, Chris, and everybody else. In markets, we have always seen cycles. There will be ups and downs, and I think 2020 was something that definitely taught us a lot of lessons. But it also taught us one very strong thing, which is stick to basics. And what does it mean? It means that irrespective of conditions, irrespective of market cycles, the basic job of finding the right companies with the right management, with the right outlook, with the right governance, and hopefully, with the right outcomes remains the same. As we all know, in investing, asset allocation plays a very, very important role, and I think that got exacerbated further. These are some of the lessons. But at the same time, I think it also taught us that we need to be nimble, we need to be proactive, and we cannot take anything for granted. As Jacob and Chris mentioned, there have been issues around, let's say, exits. There have been issues around what has been the wherewithal of the Indian ecosystem to manage the entire process. But now that sort of we are almost 1 year down the line, at least my view is that overall India seems to have managed the whole scenario reasonably well. Yes, of course, initially there were a lot of issues and India did face a very strict lockdown. And, as a consequence, a lot of processes got elongated. As you mentioned in your opening remarks, fundraising was challenged, it got elongated. Similarly, I think the investment process also got elongated, whether from LPs into the funds or indeed from us, from our perspective into specific companies, simply because of the way we all were used to doing things. And I think it taught us several lessons also, that probably there are better ways of looking at things. From our perspective, actually, we very quickly realized that perhaps doing things in a more digital manner is actually better from the longer term. It sometimes becomes more efficient. And also, it also opened up eyes to the fact that there are actually certain businesses, certain companies which actually can emerge stronger. And indeed, for example, in our portfolio, we have seen cases where people have actually emerged stronger out of COVID and how to sort of manage that. It also brought, I think, sometimes in the good times we lose focus on certain basics in terms of cost, efficiency, transparency. I think this focus was brought right back. And if I see, the companies that have actually emerged stronger, some of them actually improved their efficiency significantly, and perhaps it will be permanent. From our perspective, I think because we are a multi-asset manager, it resulted in recalibration across all our verticals. On the PE side, we see some significant trends. Digitalization was obviously already a trend, but I think now it has become mainstream, irrespective of the business that you are in. On the real estate side, I think the government's focus on certain segments, especially affordable, actually has really helped. On the infrastructure side, I think that's the place where government is actually bringing in a lot of effort. They're bringing in a lot of ideas. They're bringing in assets into the market. I think all of that is helping. And clearly, going ahead, this is going to be a good trend which will help both LPs as well as GPs.
Thank you, Puneet. I think those are a few crisp bullet points which are your consideration. And a lot of these points, and I pick up from your last couple of points around government push which has happened. And Jacob, coming back to you, and Chris, maybe I'll start with you this time. Both of you talked about COVID hitting India perhaps harder than other countries. But the reality also is that, albeit a bit mysteriously, but COVID has receded in India dramatically. And more importantly, when we look at, the forecasts put out by IMF, other institutions, and indeed the government's own estimates, India is going to bounce back very sharply in the next fiscal. Estimates, of real GDP growth being sort of 9 to 12%, which would put us back to growth even from a 2019 base. Will this trigger any changes in your outlook with respect to the strategy for India in 2021 and beyond? What might look different? Chris, if I may come back to you for that.
I'm quite cautious about the outlook for stepping up the pandemic. You see that China had it under control, like they had 0 cases for a long time, and then you see it bouncing up again in certain cities. The same thing is happening in Korea and I think in Japan. So Japan is trying to kill it because it's trying to organize the Olympic Games, right? So this is a really tough problem to solve. So we may be entering a situation where every country has to fight this disease for a long time. We are thinking of time frame of five years or more. So that's going to be a constant. So what's going to change? The change is probably on the exit side. Because of global quantitative easing, stock market is booming. So the demand for private companies becomes huge, and it's this vacuum that's creating opportunity for investors to make some capital gains for their investors. I think that's the change that will catalyze the whole industry.
Those are interesting thoughts. Jacob, anything to add to that? And especially, I'd like to maybe both of you to opine on a point both of you made in your opening, which is going forward, the need for greater due diligence. I think Puneet also touched upon that, and greater vigilance. Jacob, over to you, sir.
Okay, thank you. So I think I totally agree that COVID is kind of a concern, and then we are kind of trying to find way to how could make good return in the market. So first we look at the COVID is that so it really changed the behavior of most people and also the private equity industry as well. So you mentioned the way how due diligence, but the way most people are now still working from home, and then with very limited or no travel, and doing a lot of video calls. You mentioned that last year we were in a conference, but now it's more video. We have less paper. we may need to kind of upgrade our IT system, upgrade our IT equipment, and now, I mean, at least for me, eat a lot more takeaway meals than in restaurant. So in my opinion, that invest we will be kind of focused more on the online businesses, and then new economy, healthcare, online education, IT related. So these sectors are quite attractive. Not necessarily as Puneet, they are GP and could be a more narrow, but for us, it's as LP could be a little bit wider. It would be very difficult to us to invest in very narrow. So we also review our portfolio and see what adjustment that we need to make so as to be a more well balanced and diversified portfolio. So in terms of the due diligence on GP, so in 2020, so we add another layer of DD, so-called crisis management. Crisis management may be too serious. So what it means is more the ability of GP to handle investment during the COVID situation. So we particularly look at areas like liquidity of the company, revenue reduction, supply chain, move business to online, this sort of thing. So I think we would like to really see the GP actions and how they change the action and affect the result of the portfolio company. So I mean, we do a lot of video meeting than face-to-face meeting as alternative. But I would say that video meeting would take a lot longer for us to get the comfort compared to face-to-face meeting. On face-to-face meeting, you could a lot of interaction and also a lot of informal chat that would get us more comfort. So which means that for doing due diligence, it would take us longer compared to 2019 or 2018. At that time that it might take us something like 8 weeks to complete, but now it would take us something like 12 weeks or even longer to get us to that stage.
Interesting thoughts. Puneet, would love to get your thoughts on this. I think you also have a view that digital interactions have actually caused a lengthening of the fundraising as well as investment processes. And some of the other points that I'd love to get your thoughts on those as well.
Yeah, so, I think there are always pros and cons of everything. Clearly, as Jacob very rightly said, face-to-face interaction gives more comfort. But on the other hand, digital interaction is so much easier to organize, and you can do it so much more frequently without traveling. Now, I have been in the Indian markets for more than 25 years, and a large part of my career over the last 20 years was part of an insurance company as an LP. And of course, in recent times, I've joined ICICI Venture as a GP. So I can think from both perspectives, how LPs think, how GPs think. And clearly, as an LP, I always felt that the kind of communication, transparency that GPs provide is actually one very big differentiator. And likewise, I can say as a GP, the kind of communication, transparency that portfolio companies provide also becomes a big differentiator. I think it is roughly similar. At the same time, in a crisis, you also are able to figure out the kind of entities who are actually able to convert these into an opportunity. And again, I will go back to my own experience being part of the Indian life insurance industry since it started. The industry started in 2000, 2001. There was good growth, and when the global financial crisis happened, of course, it hit everybody very, very hard. But I think out of that emerged the first seeds of digitizing various processes in the insurance industry. And there are, I'm aware that several of my colleagues from the insurance industry are here as LP. And, that was, I think, a transformation which has actually helped significantly during this COVID crisis. Because if from scratch we had to start during this COVID crisis, it would have been very difficult. And hence, the way we look at companies now is those who are trying to find opportunities here and are able to convert it into something which can have long-term sustainable advantages. One very big advantage that I saw of the COVID environment was that, overall for us, amongst our various portfolio companies across various verticals, our companies employ about 15,000 people in different parts of the country. And earlier it was almost entirely focused on what are the business outcomes, and of course it remains there. But I would say in this, I would give credit to each of our companies. Not only did they keep the revenue counters ticking, they increased cost consciousness, but most importantly, I think focus on people, focus on human beings, their health, safety, including the mental health aspect, whether for employees, customers, vendors, improved significantly. And I genuinely feel this is a very, very strong improvement in the way things are done. And genuinely, I feel that in the long run, these are going to be very significant drivers of change versus what we would have probably seen over the last 20 years. As was mentioned, this forum itself, for the first time we are doing digitally. Yes, of course, there are challenges, but imagine the advantage of doing this forum digitally. Anybody, anywhere in the world can log in and see without having to travel. So, I would rather look at the positive side of it and see how we can take advantage of that and move ahead.
No, absolutely, absolutely. And, our business, as it were, that is our events business. So just share with both of you, well, all three of you, what we've seen is a deepening of our audience, especially from in India, which otherwise was simply not possible, because most of our events would happen in our Mumbai or Delhi or wherever it is, and people would hesitate to travel beyond the point. It's interesting. I think the other theme that we've seen catching more and more steam in the last year has been the whole notion of ESG, kind of transitioning from just being a box-ticking exercise to one which both LPs and GPs are taking very seriously when they look at companies and sectors to invest in. But I guess that's a discussion for another time. One thing I would like to pick up, I guess, Puneet, let me start with you and then I'll go to our LP guests, which is, typically LPs are running on sort of 8 to 10 year cycles. And both Chris and Jim mentioned earlier the challenges of exit. Now, how do you balance this lengthening of the investment cycle with the need for exits, with the need for capital recycling? I think Jacob talked about that. And as a GP, how, it's a little bit of a seesaw. You don't want to exit too early from a company either. You want your, IRRs to be optimized. So tell us a little bit about how you folks kind of balance this equation.
Well, that's a good point, Jaideep. But, in my mind, honestly, the focus on exits or, DPI as we call it, actually has to be laser sharp all the time. Good times, bad times, ultimately, if LPs are providing capital, it is not just our responsibility, it is our duty to return, by way of distribution or whatever to LPs, whatever their expectations were. And I personally feel that it's not as if that has changed or anything during this period. If anything, I think it has brought more clarity. Because what happened early on was, as you know clearly, exits took a backseat because of whether it is market conditions, whether it is, the fact that you couldn't interact. But I genuinely believe it brought more clarity on the need to do this and within the desired time frame. And in some ways, as was mentioned earlier, I think the public market environment has helped. I think what has also helped is globally, there has been significant liquidity that has been provided by every central bank in the world, which has had two impacts, right? One, of course, is it has helped manage, the financing part for the individual company. So, in a normal environment, and I still go back to the GFC, financing was a huge challenge, whether you are a big bank or whether you are a small company. So, I think the robust liquidity conditions have really mitigated that. But it has also helped in the fact that it has created a reasonably positive market environment from an exit perspective. Now, those exits, obviously, there can be different strategies. But I still feel, I think the basics remain the same. It is our role, responsibility, duty to keep thinking about it all the time. And genuinely, that is where good GPs get differentiated.
Wonderful, wonderful. It's a responsibility to make sure LPs get the money back. Jacob, let me get that statement back to you. The LP perspective on balancing, the cycle with lengthening investment cycles with exits. Quick comments on that, and then I'd like to just jump to the last section of our discussion.
I'm sorry, I didn't catch your question.
Okay, so that's all right. I was saying that this whole notion of the 10-year LP fund cycle, balancing it with the lengthening investment cycles in sort of end investment companies, and how GPs are driving exits, which in turn allow them to return money back to you. What is your view of how this is evolving in the COVID era and looking at 2021 and beyond, given that the average investment time in a particular company seems to be lengthy? How do you balance this?
Well, I think so one is that the private equity in Asia is relatively new, and there's some kind of misunderstanding, communication, kind of between GP, LP, and some GP would the way that how they construct their portfolio. So if they construct their portfolio is try to maximize the return on every single company, that would take the maximum time to get to that. So that would get into the situation that if something go wrong, and then it would need a lot longer. But now I see that from a lot of GP, the way they construct their portfolio is that with some company with a shorter duration that they could exit, some would be in a medium term, and some would be take longer term to capture or maximize the return. So that for those GP would be more LP friendly, and LP would prefer to work with those GP with that concept. So this is what I see in the market.
Wonderful, thank you, Jacob. Chris, last couple of minutes I've got left. I want to come to you for your thoughts. When you folks are looking at investing your fund, it's not just a case of which GP to choose, but for that which country to choose. So when you look into the future, where does India stand in your mind in the pecking order in terms of its attractiveness relative to Malaysia or Indonesia or Singapore or so on?
Yeah, I think those are good comparables because India is a high growth developing country. So you got to compare it with other high growth economies like Indonesia. So the developed countries in Asia are not really comparable. So there are a lot of, if you compare India with say Indonesia, there are a lot of similarities where you have large domestic consumption driven economies where people's income is growing rapidly compared to historical pace, and so that those are all very encouraging macro data points. But when you cut it to one level lower, that also means that consumers are very price sensitive with respect to products and services sold to them. So companies have a much lower gross margin compared to companies in the developed countries. As a result, with lower gross margin, it takes you longer to build a sustainable business. Time to profitability is longer. And then as a result, we have this problem that we keep talking throughout the whole forum. Time to exit is long because you have a profitable business. You always have buyers for a profitable business. So I would say the Indonesia and India are quite comparable in that sense. So what can the GP in India do to right now we start at the start of conference you mentioned fundraising is tough. So how do you differentiate yourself in this environment? So the answer is just exit. The first GP who can show realization in his fund will stand out against his competition when it comes to fundraising. That's the bottom line. How do you get exit in this environment? First thing, ideally you have a profitable business that can be acquired or go public. Even in India, profitable companies go public all the time. And you have companies that are fast growing but not profitable yet. Hopefully you can go public in the US. The Nasdaq is willing to take them. Maybe now you can even sell them to a SPAC. And then the last thing is go after for other companies which are younger. Then they can be sold to other secondary fund managers. You can talk to Axiom. We also buy some of these positions directly into some of these non-profitable private companies that will take a few more years to mature and will be beyond the fund life. But in the meantime, you can show some distributions, and potentially that differentiates you in your fundraising process.
So I guess the message is India is attractive, but ultimately cash is king. Jacob, Chiu, Chris Lowe, thank you for joining us. It's been a real pleasure hosting you and moderating this discussion. Puneet Nanda from ICICI Venture, thank you so for joining us as well.
Thanks, Jaideep. It was quite a pleasure being part of this discussion. I think some of the insights that Jacob gave, Chris gave on how LPs would look at GPs, very, very valuable. If I just cast my eye over the last decade rather than just the last 1 year, I think the AIF industry has accounted for about $250 billion of long-term sticky capital for India. Given India's growth aspirations going forward, and then combined with the structural issues emerging out of COVID, along with the regulatory changes that are happening, I think will only heighten the need for private capital in India if the country indeed has to achieve its growth aspirations. For LPs, whether global or domestic, I think India's investment climate has continually improved, I would say. Of course, there is always scope for further improvement. The government is quite focused, I would say, on ease of doing business, has truly embraced global investors, given the kind of outreach that we've seen, especially over the last few months. In spite of some of the hiccups, I think the taxation framework in India for AIF industry has now attained greater stability, predictability. Of course, we could always want taxes to be lower, but clearly there is more stability and predictability, certainly over the last few years. I think we must also give credit to the Indian regulators. The regulatory framework is now truly pushing for greater transparency, accountability, consistency, especially among GPs. And as an LP, as I said, I definitely would welcome it, whether I'm a domestic LP or a global LP. Overall, what I see is some level of pragmatism is indeed required if you want to lend balance to all of this. From a GP perspective, operating in India, whether you are a global or a local entity, India was, is, and perhaps will remain a complex market to invest in. And specifically for that reason, I do feel local GPs will continue to have a competitive edge. Of course, new disruptive forces in the form of digitalization or whatever else will continue to add a new level of complexity, but also create opportunities to create winning sectors, winning companies, winning teams. And one of the learnings is that there will be greater flight to quality, and hence, choosing those kind of entities will become an even more important task.
Absolutely. And the new group of unicorns that we've seen, especially I think EdTech was mentioned by JP as well, is a huge opportunity. So I must jump in because we are flat out of time. My producers are waving their hands frantically because our guests and speakers are waiting. I am going to thank you ever so much, gents, and thank you, Puneet, Chris, and Jacob, for your wonderful thoughts, for your contributions, and most importantly, for taking time out and supporting the Limited Partner Summit 2021.